emissions reduction is not always the best metric, even for measuring emissions reduction. Understanding like the inner logic of corporate clean energy procurement is going to teach you a lot more about the long-term drivers of a lot of these companies' emissions reduction than sort of taking the output, the headline emissions at face value.
Hi, everyone, and welcome to the Climate Tech 360 podcast, where we connect with diverse voices in the climate sector to make informed choices in supporting the future of climate technologies. I'm your host, Samia, and today we are speaking with Nolan Lindquist, the Executive Director of the Center for Active Stewardship, or CAS, which is an affiliate project of the Jain Family Institute. Nolan was previously a director at Fidelity Management and Research, where he focused on private equity investments across consumer-facing industries. And prior to that, he was an equity analyst at Fidelity covering communications. Nolan holds a BA from Amherst College, where he graduated summa cum laude and studied history. In this episode, we talk about the work that CAS is doing in climate-related shareholder proposals. And then we get into the main discussion around whether emissions is really the right metric when measuring the financial materiality of climate change for a company. And if that metric is not emissions, then what are the right metrics or disclosures? We talk about a tool that CAS has developed called Splice, which is used for visualizing how a company's emissions have changed over time and really breaks down how companies actually achieving their emissions reduction. This is an important conversation, I think, for anyone working in climate, really, but especially for people working in corporate sustainability, carbon accounting companies, and equity analysts who are trying to calculate a company's carbon assets and liabilities. I've linked a number of important articles, reports, and that Splice tool in the show notes. And I would highly recommend that you take a look at Splice while listening to this conversation so you can follow along. And now onto the episode. Okay, Nolan, hi. Welcome to the podcast.
Thank you, Samia. Happy to be here.
So as you know, I learned about your work after reading an article in the FT where you were quoted. And I think it came out about a month ago. It was called The Case Against Carbon Emissions as a Universal Metric. I'm going to link it in the show notes. But for context, can you tell me a little bit about the Center for Active Stewardship, your work there, and why specifically you focus on climate transition risk?
Great. Yeah, happy to do that. So I'm really an equity analyst at heart. My happy place is reading through corporate annual reports, thinking about how companies and industries will evolve over time. And after college, I started out at Fidelity picking media and internet stocks. In 2022, I got connected with the Jain Family Institute, which is Bobby Jain's research nonprofit and philanthropy. They were looking to fund a project basically looking at how investors influence public companies on climate change. And I learned about two big dynamics that were playing out that I found fascinating because I just didn't understand them at all. One of these was investor support for activist shareholder proposals on climate issues had been increasing massively. From 2019 to 2021, it ramped up significantly. And if you calculate the success rate of these shareholder proposals by giving activists credit for withdrawn proposals, so proposals that they pull back when they reach an agreement with a management team, the success rate for these proposals reached something like 2/3 in 2021. They were winning at really high rates. And beginning in 2022, support for these proposals started to crack, and that's continued over the past few cycles. So understanding what was driving that change over time was really intriguing. And then the other big thing that was actually more counterintuitive to me was learning that there are huge differences in support for these proposals across different asset managers. So it literally runs the gamut from firms that support nearly 100% of these activist proposals to firms that support de minimis and some even 0%. And so on our side of the table, as an investor, we'd all been talking the same language. We'd all been talking about, financial materiality, ESG integration, keeping an eye on climate-related risks and opportunities when that's appropriate. But it turns out that everyone was running that playbook in a completely different way. People were voting in totally different ways and not being close to it because I was like a TMT guy. I was so puzzled by this. And I thought, this is an interesting intellectual puzzle. There's also an interesting impact story here. And having a little bit of an adventure and building a nonprofit could be really fun and interesting. And so I jumped ship and joined JFI to build out this affiliate project, which we call the Center for Active Stewardship. And the way that I would frame the theory of change is that we're basically trying to find a point of leverage that can ultimately drive corporate investment behind net zero. So redirecting some marginal slice of the trillions of dollars of cash flow generated by publicly traded companies globally toward mobilizing the proverbial trillions that we will need to invest to decarbonize the world economy. And the way that I think about that is basically we need to find win-win opportunities where you can tell a story, like a convincing data-driven story that links ponying up some amount of money to mitigate what I call a carbon liability or create what I think of as a sort of climate policy asset, where you can tell a story that links that investment to driving shareholder value. And I think that opportunity set is as big as it's ever been. It looks really different from how I think a lot of climate NGOs thought it might look a couple years ago, and we can get into why that is. But I still think that theory of change makes a lot of sense. But I think implementing it requires building a lot of new muscles and approaching these issues in a little bit of a different way than the ecosystem has approached them in the past. And that's what's really exciting and really interesting. And to get into the meat of your question, transition risk is like a little bit of a squishy concept. It's something that you hear about a lot. The idea is basically recognizing that this global drive to get to net zero might be financially material for a lot of companies. And there might be some, let's say, loose relationship between who's facing these transition risks and who is currently generating a lot of carbon emissions, right? So in my mind, what I think is the most rigorous way to frame what transition risk could be is that it's really policy risk. It's really the idea that public policy is going to shepherd us along this net zero pathway. And so public policy is going to evolve over time, and governments around the world are going to implement the set of policies that global consensus has decided will drive net zero. The issue, of course, is what's global consensus? What is the expert view? The reality is getting to net zero is as much a social and political and economic problem as it is a technical and scientific problem. And there are many different ways to get there. There are many different end states of the world in terms of global energy intensity, so how much energy individual people use, and how we get that energy, right? Some people envision a world with abundant, cheap nuclear energy provided by small modular reactors. Some people think that hydrogen will play an important role as an energy carrier. Some folks think that solar and batteries will eat the world and will provide the vast majority of energy. So there are a lot of different valid perspectives, often backed up by very rigorous modeling on what the end state mix of technologies is going to be. And layer on top of that uncertainty around, well, what policies do we put in place to make that happen? And so the reality is it's much more of a fluid and slightly chaotic dynamic than you might think just drawing on a whiteboard some smooth glide path all the way down to net zero, right? And the upshot for investors is, by and large, the climate policy idea circa 2018, 2019 was largely, we're going to tax carbon. We're going to price carbon. I think that's an okay heuristic, and we'll get into this later because it comes up in our research. I think it's an okay heuristic for screening companies. Let's assume an illustrative carbon price. Let's multiply our emissions by that carbon price. Let's discount it to today. That's the carbon liability. I think that's like an okay heuristic, but we need to accept that it's a fuzzy estimate. There are some big error bars around it. It's just a sort of tool. But what's changed is climate policy is now much more about marshaling public and private investment in new technology. It's about the supply side and not the demand side. And it's about carrots and not sticks. And that really matters because suddenly, in the TCFD framework, there's this acknowledgement of climate related risks and opportunities. And if you look at the way that ESG ratings are calculated, for some industries like MSCI and other ratings providers will include some indicator that represents green opportunities. And it's given some weight in calculating ESG scores depending on the industry, right? So there's some acknowledgement that this is real. But I kind of don't think this is my view. I'm very skeptical that there was ever any structured, rigorous, consistent way to quantify what those opportunities might be across industries until policy evolved. And what happened was we got in the US the Inflation Reduction Act, and suddenly you have a laundry list, a very exhaustive laundry list of specific tax credits with their own specific mechanics that are directed at qualified investments in a bunch of different important supply chains. And what that means is suddenly what I think of as the climate policy asset, which is basically the free money that you get from these subsidies as a corporate if you invest in the right value chains. That asset is now much more quantifiable than it's ever been. And it's really big. And the reality is, climate NGOs like to focus on upstream oil and gas. And I think there are valid sort of like political, like tactical, movement building considerations there. But we're not a political, tactical movement building organization. We do financial research. And so we try and call balls and strikes. And if the theory of change is routed through, we'll convince upstream oil and gas companies that they have a big net carbon liability on their balance sheets and that it's in their own best interest to wind down production, I don't think that's all that credible anymore, because a lot of these companies are also able to play on the molecule side of the energy transition and benefit from IRA tax credits for low emissions hydrogen, for carbon capture and storage, for all of these emerging industries where I think, the oil and gas majors have, manifestly have like a right to win competitively. And so what that means is the way that these campaigns have focused on that industry and the way that they've sort of framed what corporates can do needs to evolve. And I think it needs to focus much more on what are the companies that are enabling substitution away from fossil fuels? Who's selling us the stuff that enables us to substitute renewable electricity for fossil fuels as end users of energy? And so that kind of investment-led focus, I think, is really in early innings of being assimilated by the ESG bureaucracy as it exists across financial institutions and data providers. And we are basically trying to ride that, and we're trying to participate in that and shape it with research and thought leadership. And then we're also trying to think through how can we harness the shareholder engagement process to that? So how can we come up with smart, tactically savvy campaigns? Or how can we sort of like flesh out what some of the right targets might be that align with that conception of sustainability? How can we give asset owners the tools to sort of figure out, okay, how are the managers that I work with taking this on board? How are they implementing that in their proxy research and stewardship functions? And how are they voting? Are they voting in a way that seems consistent with that view? And then for asset managers, how can I get abreast of these issues? I sort of think sell-side research from banks is great. I've used it a lot. I have a lot of respect for the different sell-side research analysts I've worked with in my career. But I do think it can be a challenge for that model to do cross-cutting thematic research on issues that are sort of like 5% of the story for a lot of different companies. It's just not easy to like build a business case around if you're in a hard dollar research business. And so what I'm really trying to do is be a helpful resource who can fill that gap for fundamental investors and then also for ESG teams and stewardship teams.
You just covered a whole bunch of concepts that we're going to get into more detail on, but I wanted to start with the most basic element, which is emissions and metrics and what we're using as a metric effectively. You have said that emissions is a vanity metric. I think it's really interesting that you said that. Obviously, we're like hyper focused on emissions on the investing side. From an impact perspective, that's what we use to measure impact. So emissions reduction or potential emissions reductions. And that it's a narrow view, right? So I wanted to reference this excellent white paper that you guys wrote. It's called The State of Play Proxy Season 2024, which I will also link in the show notes. But you break down the emissions of the Russell 1000 companies, an index that covers 90% of US equity market cap. And you note that the vast majority of the R1000 Scope 1 and 2 emissions are generated by companies making up less than 10% of the index by market cap, which means that investors can take a tailored company and industry specific approach. And you talk about how emissions are only financially material for a few sectors like energy and utilities. And for the rest of the index, decarbonization will likely be a passive process. Can you get into this further, potentially using some examples so that people can understand?
Great. Yeah, happy to do that. So I'm going to start with a kind of deliberately esoteric statement. Think of it as like a Zen koan, which is that which is like emissions reduction is not always the best metric, even for measuring emissions reduction.
Yeah. Okay.
And what I mean by that is unless you're just doing a naive modeling approach where you're flatlining emissions or you're just looking at the linear trend over time, they don't tell you much about what's going to change in the future. And that's problematic because equity markets don't look at today, they look at tomorrow, right? But to get into your question about the distribution of emissions in the Russell 1000. So the way that I modeled this was basically anchoring on the International Energy Agency's long-term scenarios. And if you spend much time in the climate NGO space and in the shareholder engagement space, you will probably come across the International Energy Agency's net zero emissions by 2050 scenario. That gets talked about a lot. The thing to note is that that's not a forecast. That's a sort of what if exercise. That's taking a certain emissions glide path as a constraint and solving for what is the least cost way to deliver on that emissions pathway. It's not meant to reflect either base case where we're going or where we would be going if governments around the world followed through on their various pledges that they maybe have not backed up with concrete policies. So I don't spend a lot of time with the net zero emissions scenario. I think about it as a way to come up with targets or goals or bogeys for companies, industries. I don't think about it as a forecasting tool. But what you can do is you can basically take the IEA's forecast electricity mix in their more conservative scenarios. So stated policies, which is base case, that's business as usual, and announced pledges, which is basically governments around the world do what they say they want to do, and they actually back it up with real policies. So what you can do is forecast a glide path for the way that I kind of break this down, which is OECD and non-OECD. You can forecast a glide path for the emissions intensity of electricity based on those IEA scenarios. And that chart is somewhere in the white paper, which I guess you'll share in the show notes. But what you can basically do is for each industry in the Russell 1000, each of the over 100 GICS level 2 industry categories, you can look at what is the energy mix today. So how much of this industry's energy use is grid electricity versus directly using fuel on site, burning gas in a generator, or we operate a fleet of trucks, or we have boilers powered by fuel oil or whatever. And you can look at that mix, and then you can just make the assumption that the emissions intensity of the grid electricity they use is going to follow this long-term pathway laid out in the SPS and APS scenarios. And what you can then do is back into, okay, well, what does that imply for emissions intensity, right? Because each dollar of sales is powered essentially by this many megawatt hours of electricity. Right. Yeah. And this many megawatt hours of other energy. And the kilograms of CO2 for each megawatt hour are going to decline along this forecast trajectory. And what you find is in a lot of industries that basically don't use that much energy and use mostly grid electricity for their energy use, those companies are basically automatically going to deliver an emissions reduction CAGR that is in line with or faster than the science-based targets threshold. And you see a lot of financial, so capital markets is an example of this. I forecast capital markets and some of these fire industries and software delivering, even if they do nothing at all, a 7 to 8% or faster annual reduction in emissions intensity under the APS scenario. That's a lot. That's a lot. I mean, setting aside whether the world decarbonizes that fast, I mean, it's an aggressive number. And by the way, I should say this is a CAGR from now to 2050. But if you look at that list of industries, it includes a lot of industries like, for example, software that represent a lot of the value of the Russell 1000. And so,
right.
Like if you have a software company, if you have an application software company, that's not really investing a lot in infrastructure, the tech majors are a different story. But if you have an application software company that's richly valued, the financial importance of energy and of emissions is really small because you've got a valuable business and you just don't generate much in the way of direct emissions. And what emissions you will generate are going to kind of take care of themselves because utilities are going to have to deal with a much more intrusive matrix of regulations and investor demands that will push them to decarbonize. So that's what I mean. And there's a much larger group of companies that are modestly energy intensive and use a lot of electricity. And for those companies, especially companies where the energy intensity of sales is pretty linear over time. And the tech majors fall into this bucket actually, because energy is a real input to generating a dollar of sales. In their case, because energy is an input to compute. And so for those companies where to grow is to increase demand for electricity, I think there's a much more strategic conversation to be had about how we procure clean electricity and how we do that in a responsible way, and whether it's worth paying a little bit of a green premium now to help these industries scale and see some learning effects. That's a little bit of a different conversation. But I guess what I mean is for 80% of the market, in my mind, pretty much the entire sustainability conversation is, so to a very small extent, what is the direct emissions footprint of my real estate, whether I'm in leased premises or owned premises? Are there refrigerant emissions I should be careful about? Are there emissions from space heating and cooling that I should be thinking about? But really, it's about the emissions intensity of the electricity I buy and use from the grid. So 90% of that conversation, this is like a fake illustrative number, 90% of that conversation can be about, are you doing corporate power purchase agreements with new build solar and wind? Are you buying unbundled RECs? Are you buying other environmental attributes? So what are your sort of like electricity market operations? And in my mind, like analysts would do themselves a favor by digging into that, because emissions is like an output of that process, and understanding like the inner logic of corporate clean energy procurement is going to teach you a lot more about the long-term drivers of a lot of these companies' emissions reduction than sort of taking the output, the headline emissions at face value.
That's interesting. Okay. So basically what you're saying is, to say it in the most simple terms possible, is that when you look at the Russell 1000, a good proportion of those companies, for 80%, for example, the software industry, as their sales go up, their energy intensity, their energy usage isn't really going up. It's really about scope 2. And that is going to be taken care of as utilities shift away from fossil fuels to renewables. And so for those companies, looking at emissions doesn't really make sense.
Right. We should be talking about electricity and not emissions.
What about the remaining 20%?
So that's where it gets interesting. Utilities are important. It's also the oil and gas complex. So there are direct emissions from upstream. There's fugitive methane from midstream. And refining. Refining is very energy and emissions intensive. And in a way, refining is kind of the hardest one of these to deal with. Upstream, you can, in theory, largely deal with by using electricity on site And a lot of the oil and gas majors are talking about this in the context of decarbonizing production in the Permian. And so, for example, using wind power to power oil and gas extraction, right? But refining is a big challenge. So the other energy and emissions intensive industries that are in that top X percent are generally what are called the hard to decarbonize industries. And those are overwhelmingly materials companies. So cement and concrete,
Steel, concrete,
aluminum,
cement.
iron and steel, bulk chemicals. And these are really hard because they rely on high heat, which we can't really produce with electricity in a cost-effective way right now, and or chemical reactions that inherently generate emissions, which are inherent in industrial processes that have been evolving and have been getting more efficient and have been improving for decades and decades, right? And so we've got these really optimized processes that rely on high heat and on chemical reactions that inherently generate a lot of emissions. And so that's a big problem. And so for those companies, it's less, the reason why I say we should be talking about inputs and not outputs is if you talk about outputs and you're holding these companies up to a standard of, okay, well, let's try and reduce emissions by 3 or 4% a year. What you do if you are trying to squeeze out a few percentage points of incremental efficiency, right, or of incremental emissions intensity gains, is you optimize existing processes. You optimize existing processes, you improve and refurbish existing infrastructure. That's just what happens when you impose that kind of condition or constraint on an organization, right? You optimize what you're already doing. But if these companies are going to decarbonize, what they need to do is actually radically shift their production processes. And they're going to need, by the way, a lot of public support to do that, because from a corporate perspective, that's really scary. I mean, you're in a capital intensive commodity business. You're already this cyclical that maybe doesn't generate the most attractive returns on capital on a full cycle basis. You're not a company that invests a lot of money from advantaged franchises on R&D. Like, that's not the playbook. And so what you need is a lot of clear line of sight into where you will be able to find government support for making these long-term strategic investments. And so that's what you're seeing, for example, in the EU with a lot of the direct government support you're seeing from Germany and France for direct reduced iron steel production, right? You really need this long-term visibility into how policy is going to ease this transition, because it's really quite difficult and it's really outside of the scope of what it takes to run a sort of like asset heavy, capital intensive commodity business, which is like the playbook for that is we are going to operate really well and really efficiently. And we are not going to take a bet on the price of the commodity. We're just going to try and invest in projects that will be at the bottom of the future cost curve. And over time, we'll work out and we won't blow ourselves up because we won't invest in high cost projects and we won't take on too much leverage. Inherently, evolving to a completely different mode of creating all these critical commodities is taking on a lot of risk, which means expanding your balance sheet and finding financing to do that, much of which is going to have to be debt financing to solve for a low, weighted average cost of capital. And you need to invest in things that are inherently going to be very high cost because they're first of a kind. And where's the market going to be for that green steel? And who's going to pay that green print? So it's very difficult. And so anyway, my point is, those are really interesting questions. They are highly industry specific. They require the input of industry analysts who have the expertise and then also the credibility with boards and management teams to think through those strategic dilemmas. And so they really require an active approach. And I think if you're an active manager, this is like an opportunity, because this is a way of thinking through these issues that is very hard for like Vanguard's business model to handle, because the whole business model is we are not going to have all those expensive industry analysts, and we won't need the fee structure that would appropriately compensate those analysts. We're going to be much leaner and we're going to have this index tracking product and it's going to be very low cost. But I think you need fundamental analysis and you need real rapport on strategic issues with companies to sort of navigate this next chapter, where it's not just like, okay, disclose your emissions, set a net zero target, and then you're done, right? Like
Yeah.
produce disclosures that fit this template. And if there are 5 templates, produce 5 sets of disclosures, which is kind of like the silly season that we're in. Now it's like, how are you going to navigate this incredibly chaotic restructuring of the global economy that's going to take place over the next couple of decades? And that's something fundamental investors can do. It's much harder to apply a box checking type approach to this set of questions.
Let's talk about this tool that you created, that the Center for Active Stewardship created, called Splice, because I think that is a really sort of simple and elegant visualization for looking at the source of some of these emissions. So basically, anyway, I will link it in the show notes as well. But if you go to centerforactivestewardship.org/splice, there's a list of companies and a time frame listed. So you can pick one of the companies. I'm going to pick Alphabet, Google, and that I'm going to leave it at the default time frame, which is 2020 to 2022. And it's basically a waterfall chart that gives you a walkthrough of their emissions within that time frame. Can you just talk us through what it shows us?
Yeah, absolutely. So I'm pulling this up on my screen so that we're speaking the same language. And I spent some time last night actually digging into some of the data on not just Alphabet, but the other tech majors. So what you basically see here is our decomposition of what's driving the change in Alphabet's emissions. And what listeners should know is the numbers that we use for total emissions at the start and the end of this waterfall chart are Scope 1 emissions, and that means direct emissions. So that's burning, like directly burning fossil fuels, and Scope 2 market-based emissions. Scope 2 emissions is purchased energy. Most people think of that as electricity, and for most companies, purchased electricity is the vast majority of Scope 2. It can also include other purchased energy, so purchased heat and steam, for example. And there's a big distinction, which your listeners are smart on this stuff and will probably be familiar with, but it might be new to some folks. There's a distinction between location-based and market-based Scope 2. So location-based Scope 2 just assumes an emissions factor for all the purchased energy that you're using. Generally, your utility is going to provide that to you or report it on some time frame, and you'll apply that emissions factor to the electricity you purchase from your local utilities, and that's your location-based Scope 2, and it's meant to represent the physical emissions intensity of the electricity you use from the grid. Market-based Scope 2 is different because market-based Scope 2 reflects what we call trading, all the electricity market activities you're undertaking to procure clean power. And the reason why that's different from your physical Scope 2 emissions is because not all of the clean power that you're buying is from like a dedicated wind farm that's on site, where 100% of the power generated by that wind farm or generated by those rooftop solar panels is being consumed by you. You're trying to buy clean power from projects that might be located very far from the sites where you do business. And so it's a paper or a financial transaction. And we'll get into this, but that doesn't necessarily mean that it's lower quality. It's just sort of like a reflection of how the grid works. But in any event, we think about total emissions for purposes of Splice as Scope 1 plus Scope 2 market. So what you see with Alphabet is the business grew. It got modestly more energy efficient over this time frame. So when we look at sales, we just assume the emissions intensity of sales doesn't change. So that's just the effect from the growth in sales. The energy use bar is all about, did you get more or less energy efficient? Over this time frame, Alphabet got very slightly more energy efficient for each dollar of sales. Mix reflects the way the company toggles between using electricity and using fossil fuels. It's a very marginal contributor for Alphabet because Alphabet, in any given year, 98 to 99% of their energy consumption is electricity. And so it's very marginal, and you see that in the waterfall. And then the S1 GHG and the S2 GHG lines, they represent, once you adjust for all those things, you run through this series of counterfactuals where sales changes, but the emissions intensity stays the same, and the energy intensity changes, but the emissions intensity of the energy stays the same. And finally, under mix, sales change, energy intensity changes, and the mix of fossil fuels versus grid electricity changes, but the emissions intensity of each of those drivers stays the same. What you're left with is this residual change in emissions intensity. So this is what's left, and this represents the change in emissions intensity of each of those energy sources, right? So the fossil fuels your company uses on site and the grid electricity that you're purchasing. And so what you see is the emissions intensity of the grid declined over this time period. The other thing you see that's interesting is the impact of trading effectively went up. Or that's a funny way of saying it because it's sort of flipping the signs. But what happened was Google offset a smaller percentage of its location-based scope 2 emissions with clean power procurement.
So trading includes buying PPAs and RECs, right?
Exactly. So if you're an analyst, I think the questions are pretty clear. It's like, okay, so Google's energy intensity has not changed much even as it's grown. That's effectively telling you that energy will increase linearly with sales. That's kind of interesting because Google is less and less of an asset-light business each year, right? Because it's investing so much in data center infrastructure. And this is sort of like telling that story because if you have like an application software company that doesn't own a lot of infrastructure, you'd expect the energy intensity of sales to fall over time, right? So that's kind of interesting. And understanding how that relationship will evolve over time is also interesting. Though I would point out that as it stands today, for Meta, Alphabet, and Microsoft, energy is really still only 0.5 to 1% of sales at typical PPA prices. So it's not super material yet, but watching that over time is interesting. But the real story, of course, is trading. What's going on there? In 2019, Alphabet offset almost 85% of its location-based scope 2 with PPAs and RECs. That proportion has gone down a lot. And so, you would really want to drill down into this. And if you have good corporate access, it might even be worth, a one-off conversation with the chief sustainability officer or whoever is in charge of energy procurement and understand why are your purchases of PPAs and RECs growing more slowly than your electricity consumption? What's going on there? Is that a supply issue? Is it because the cost has become prohibitive? Are you waiting on XYZ? It opens up all sorts of really interesting, like tactical and strategic questions that just go one layer deeper than, Google's emissions went up or down X%, or they seem to increase a lot. What's happening? They just allow you to tee up like, okay, what is happening literally one layer deeper? What person at the company might be a subject matter expert in this stuff? How should I frame this issue in a smart way that the management of the company can actually respond to and that actually sort of foots with their strategic priorities?
Companies like Google, they're part of Frontier, but they buy a lot of removals and offsets. And so that's obviously not included in this waterfall analysis, right?
Correct.
I wonder if it's a question of, it was cheaper to buy offsets than to buy RECs, something like that.
Yeah, it's a good point. And a future version of Splice that includes scope 3 would probably include those as well. Because you can technically offset any of your emissions. I tend to think of offsets and beyond value chain mitigation broadly as offsetting scope 3. But to your point, yeah, they're really all part of one strategy. And so they are important. That is an important piece of context for sure, if you're doing a fulsome analysis of Alphabet's emissions.
And you have said before that trading activities are considered, so buying PP and RECs are considered lower quality source of emissions reductions. Why is that?
Yeah, it's a great question. So what I would say is maybe just 1 degree more nuance than that, which is they can be lower quality. And often users of financial statements don't have the data to judge where the gap between location-based and market-based scope 2 is coming from. And what I mean by that is there's a spectrum from PPAs bundled with RECs for new build solar and wind projects. The additionality of that is very clear. You're providing someone with 20 or 30 years of offtake and you're basically making a new renewable project bankable. That kind of corporate PPA is gold, right? Like that's really valuable from a decarbonization standpoint. It's also much more expensive, right?
Yeah.
And
Yeah.
what you can do instead is buy unbundled RECs. And these cost an order of magnitude less. They cost like a few dollars effectively. And often the additionality is not so clear. And if you look at the green power market in aggregate, the unbundled REC market is slightly, at least as of 2022, was slightly larger than the corporate PPA market. So voluntary PPAs in 2022 in the US, the total deal volume was 90.1 million megawatt hours. For unbundled RECs, it was 110. So the unbundled REC market in volume terms is slightly bigger. And so the temptation is, well, these unbundled RECs are cheap. As my mom used to say about food, it's all the same in your belly anyway. And I can tell my stakeholders that my market-based scope 2 emissions are really low. And some companies allow you to connect the dots because they publish their responses to the CDP questionnaire. And so if you really want to spend a lot of time hitting Control F in a PDF, you can find from Microsoft, which does a real service to everybody and publishes their CDP questionnaire, you can find for Microsoft the volume in megawatt hour terms that they purchased across all these buckets of different green power procurement options, which is great. That's really helpful. It's very labor intensive to turn that into some kind of analysis of change over time, but you can do it. A lot of companies don't make that information available, and it's problematic because A, you don't know anything about the real decarbonization impact if you don't know what instruments the company is buying to drive that wedge between location-based and market-based scope 2. And you don't know anything about how much it costs, right? Because if a company is offsetting a huge volume of location-based scope 2 emissions with unbundled RECs, and over time, for whatever reason, they decide that they have to procure high-quality corporate PPAs instead, the cost of that is way higher, right? And so that's a sort of the company's existing free cash flow does not reflect the kind of investment in green power procurement they would need to make in order to purchase these higher quality green power procurement options, right? And so there's sort of like an over-earning dynamic that you could spotlight that way. So that's why transparency is important, and that's why we bucket it separately. We still include it, which is why the total emissions and Splice includes market-based scope 2. But we bucket it separately because it's a separate driver. And the key thing is to disconnect it from what's going on in the grid. Because if you're operating in a market where the emissions intensity of the grid is going down a lot, that's great for you. Your emissions are going to go down a lot, but it's not because of something you did. And so it's just like a misunderstanding. Like if you walk into a meeting with a company and you're like, wow, like you guys are, your emissions are declining so fast. Like, what are you doing there? And it turns out that that's just because of what's going on in the grid, in the background, in the geographies where they operate. You've already botched it. You've completely misframed what's happening. And you've just teed up the company telling you some promotional story about how green they are, which is not productive.
Okay, so we've talked about how for a good portion of these companies, emissions is not necessarily the right metric. And then we've talked about the importance of the emissions related to energy efficiency. So if you had a wish list of disclosures, what would they be? If it's not emissions, what should we be looking for?
Yeah, so it's great. So I think emissions and energy, which are part of the SASB materiality framework and are now required in many jurisdictions, I think are a great start. I think energy intensity on its own is really valuable. What is slightly less common is a clear breakout of the different fuels that a company uses. And for me, that's immensely valuable. And so aligning disclosures with that additional level of detail, making CDP questionnaire answers publicly available on an IR site, that's all great because that already gets us so close to what we would ideally want. Like having a breakout of how much natural gas we used, how much fuel oil we used, how much coal we, whatever. And being able to apply your own emissions factors to that and attribute total emissions to each of those sources is great. And details on exactly how a company is voluntarily procuring green power are also extremely helpful. So one example that I think is interesting to think about is the EU taxonomy, which is obviously kind of a beast of a disclosure burden. I was looking at Total Energies, the French major's EU taxonomy report, which is a PDF that is 674 pages. And that's the sort of thing where usually when companies complain, like with this new disclosure requirement is too burdensome, it's going to hit our earnings. Usually I hear that and I go, you're a 100 billion market cap company, suck it up, just do it. But 674 pages is a lot of pages. But the EU taxonomy is really interesting in that, and I don't know if you've spent a ton of time in the weeds of these disclosures, but it requires really detailed itemization of all these taxonomy eligible activities and how taxonomy aligned they are. And so for Total, I have excruciatingly detailed data on all the taxonomy eligible activities that they're doing, the share of revenue they represent, the share of CapEx they represent, and the share of OpEx they represent. I have that broken out by activity in like excruciating granularity. And I can look at the percentage of each of those buckets that is taxonomy aligned. Compare that to ExxonMobil's disclosure on environmental matters. ExxonMobil gives you an environmental expenditure total. It's broken out into CapEx and other OpEx. They define this in the 10K very loosely. This is a quote. They are ongoing measures that are taken to prevent and minimize the impact of our operations on air, water, and ground. These include significant investments in refining infrastructure and technology to manufacture clean fuels, projects to monitor and reduce air, water, and waste emissions, both from the company's operations and from other companies, and expenditures for asset retirement obligations. So it's a bunch of completely different things. And some of those things map onto green opportunities. Some of those things are like subsidy eligible. And some of those things map onto this low carbon solution segment that we've been hearing more about. And so what I would really want to do is understand, okay, like ExxonMobil's given like a long-term capital plan with a sort of big round number for future environmental or low carbon investment. But some of that is not really additional, like paying out essentially or executing on your asset retirement obligations is inherently not additional.
Yeah.
And what you would want is, okay, how much money is Exxon going to spend over the next 5 years that is going to be eligible for IRA subsidies? How much is going to fall under hydrogen? How much is going to fall under CCS? And obviously that's like fluid, and probably a lot of this belongs in some kind of occasional non-GAAP disclosure that a company shares over time. But what I would want to know, and this is the sort of disclosure that I think would be helpful for Exxon to make an ESG case. If I'm trying to think about Exxon's upstream business, one way I could think about the carbon liability would just be, let's look at the emissions intensity. Let's look at their medium-term goal for emissions intensity. Let's look at their medium-term goal for production. Let's multiply that emissions intensity glide path versus times production, and let's multiply that by a carbon price. Let's discount that back today. That's the carbon liability. So I can calculate that. I have a really hard time calculating what is the sum of the investment tax credit discounted to today that ExxonMobil is going to get by virtue of everything it's doing in its low carbon solutions business. Because I should really be offsetting that carbon liability with that climate policy asset. All the goodies that Exxon is getting to invest in the molecule side of the energy transition. But I don't really have enough breadcrumbs yet to put numbers around that in a rigorous way, in a way that scales up, in a way where I can like compare, okay, like let's look at the European majors versus ExxonMobil and Chevron, and let's think about the sort of net climate policy liability on each of these companies' balance sheets, so to speak, and let's compare it to their market caps. So full EU taxonomy alignment is probably overkill, but I wonder if for key activities, voluntary disclosure of, doing it in an 80-20 way, voluntary disclosure of revenue, CapEx, and OpEx exposure to the most important handful of EU taxonomy aligned categories would go a long way toward enabling analysts to compare US companies and think through puts and takes around climate policy to issuers in other jurisdictions.
Final question for you. I attended one of your webinars recently, and the topic was really moving away from ESG 1.0 and into ESG 2.0. And you said something along the lines of public companies have set these net zero targets, but disclosures haven't saved the world. And we need to think about what comes next, which is strategy and this transition away from ESG 1.0 to ESG 2.0, where we think about what the disclosures are for and how it ties with long-term value creation. What do you think should be part of ESG 2.0?
Yeah. So I think the big thing is, in my mind, the core concept in ESG integration is there are all these other stakeholders, and you can't screw over these stakeholders with abandon. They, on some level, have some levers to claw back shareholder capital if you treat them really badly, right? So unions, governments, fence line communities, et cetera, right? That's the core concept, and it seems to me like a very right concept. But I think where some of the thinking has maybe gotten a little stale is that if ESG is really about like policy risk and legal risk and labor relations risk, then the set of priorities needs to be updated as those drivers evolve over time, which they're constantly doing, right? And in particular, the shape of policy risk and policy opportunities around climate change is in constant flux, right? And increasingly, our bet is that it's much more focused on investment than on penalizing users of fossil fuels, right? And so chasing that opportunity is going to require digging into like what is going on in the energy system, what are governments around the world investing in and incentivizing private investment in, and how does that flow through companies' financial statements? I think the slightly stale older way of thinking is, well, we've got this like internationally recognized, expert sanctioned view of the glide path to net zero. And the reason why we were using that as a basis for scenario analysis and thinking through impacts to companies was this idea that like, well, we have nothing else to go on. So this like expert sanctioned, internationally recognized, authoritative account of how the future will transpire it's a good thing to anchor on because governments will ultimately hew to the insights of scientists and economists, and they'll do all these things that the experts have decided they ought to do. But that's not really how the real world works. And so now we have real climate policies in place. We have real coalitions forming around what climate policy will look like. And so we need to grapple with what's really going on. And I just think the mental model that I'm advocating for is like, let's not think about like emissions are important, but emissions are an output. And so emissions are like a way to keep score. They're not a way to guide what's happening on the field. You know what I mean? Like emissions are a currency. They're not like an activity, or they're generated by like the sum total of all these system level interactions between other activities. And so we need to focus on like an activity centric account of what's happening. And that means thinking about solar, wind, batteries, transmission investments, scaling EVs, heat pumps, retrofitting buildings, behavior changes like transit mode shift, and identifying the key activities by industry and sort of 80-20ing it and focusing on, in order to make the work manageable from the perspective of like an investment organization, what are the handful of industries that are really important? What are the underlying activities that drive environmental impacts for this industry? Let's focus on managing those because, by the way, they're things that are inherently central to this company's day job, right? If you're a steel mill deciding whether to invest in blast furnaces or electric arc furnaces, that's your day job. That's like unavoidable. That's always going to be on the agenda. It's not subject to the sort of the shifting political winds, right? It's inherent to what you do. And so focusing on a smaller list of things that are inherent to what companies do are kind of unavoidably financially material. are mapped onto the real input drivers of these environmental impacts that we care about, I think it's just a more practical way to implement a lot of this stuff rather than focusing on what is some abstract science-based glide path to net zero and what threshold does that imply for annual emissions reductions for a company. Like, that's, I guess, interesting. In my mind, it's just sort of a non sequitur.
Is it realistic to think that regulations will require this level of granularity, this like activity level reporting? Or do you think it's something that has to be on the agenda of organizations like CIS to direct shareholder activism to require these companies to disclose it?
A lot of what I'm talking about is already required in some jurisdictions. So the EU taxonomy, which again is like almost overkill in this direction, but the EU taxonomy is already the law of the land. And in many other developed markets and emerging markets, ISSB aligned disclosures are already being required. So in a way, the US, like the SEC climate disclosure rule, the US is like the largest single stock market in the world, but it's a bit of a laggard. And there's a lot of other jurisdictions that in aggregate total a good chunk of global equity market cap that have already adopted, say, ISSB aligned disclosure standards. And over time, I can only imagine that those standards will become more detailed and more stringent as companies get better at reporting this stuff. And so the burden of preparing the data and disclosing it falls. So in a way, I think the opportunity is leveraging these voluntary tools. So shareholder engagement, voluntary disclosures, et cetera, leveraging these voluntary disclosures in the States to make sure that big corporates don't fall too far behind standards in other parts of the world. And the upshot is that that enables comparability across jurisdictions, which is important because in the US, we have some great steel companies like Cleveland-Cliffs, but you really want to be able to benchmark globally, like auto OEMs or for energy. You want to be able to compare these companies to peers in other parts of the world, particularly because energy materials are a bigger chunk of local indices in a lot of other jurisdictions, right? Think about like Australia or Canada. And so there are a lot of comps that are overseas. And so ensuring comparability versus those peers is useful to analysts. So that's how I would frame it. We're just working to sort of true up US disclosures versus what's already happening, whether we like it or not, in other parts of the world.
And for a lot of these companies, if they are getting the tax credits, they are calculating this on their own. They're just not disclosing it.
Correct.
And that is it for this episode with Nolan Lindquist. If you found this episode useful, please subscribe and write a positive review because it helps people discover the podcast. I don't know if anyone listens to the last few seconds of a podcast. I'm usually not paying attention, but if you are, it really does help. Positive reviews really helps other people find the podcast. So please take a second to do that if you can. Thank you for listening and catch you at the next one. Bye, everyone.